The company I'm covering today took a strategic decision to sell its legacy assets back in late 2021. At the time, they had a fair bit of debt, but now having sold these assets, then their net asset value is above their market capitalization. And actually, their valuation is not far off what they hold in cash. And yet they are profitable, have a new business model with better margins, plenty of cash to acquire complementary businesses, and operate in a fast growing hot sector. Let's take a look at them. That company is Good Energy, one of the original renewable energy companies. So let's look at what they do exactly. So, they are power a cleaner, greener future, green energy for your home or your business. The green energy experts since 1999. That's very important. They're well ahead of the curve. Okay, they supply 100% renewable electricity and carbon neutral gas. 2 decades of experience there. So get off gas there, heat your home the greener way with heat pumps, go solar and save, get paid for your power, so feed-in tariffs, join 180,000 people with a feed-in tariff. What makes them different? They say we're powered by people, we stand by our green promises, we're always help to fight climate change. And they make a big deal about companies greenwashing and are not doing that because that's their original ethos was built on that. Okay, and so more reason to trust us. I said Uswitch provider, eco provider, friends of the earth, good housekeeping, Trustpilot, all that there. And Switch energy suppliers, they supply energy as well. I'll go into exactly what they do in a bit, okay? But let's go back to the original. So they transitioned. They had these generators and they sold 47.5 megawatts asset portfolio, completed a Series A fundraise to scale Zapmap. I'll talk about that. Acquired installation business, heat and solar, launched new innovative new tariffs for solar users. All right, and they've also just acquired another business, a solar panel business as well. So they sold this portfolio here for 24 million pretty much, and that means give them a big chunk of cash. And now I think in the last AGM they said they had 38 million of restricted cash, and I think it'll wind down to about 20 million when they're only valued at sub 30 million. So they've got a lot of cash. But just going over the background, they did own 2 wind farms, 6 solar farms, which supplied about 15% of their customers' energy requirements. So it's only 15%. These assets were capital intensive. They covered a lot of debt, and so they sold them, but still have a power purchase agreement to continue to source energy from them. Okay, so removed that capital intensity and the debt, pretty much got a lot of cash for them. They can still get power from them. They now transitioned to an energy and mobility services provider, which is capital light and bigger margins. So remember that going forward, their margins will get bigger and better. All right. So essentially, they've gone from this generating, transmitting, distributing to this retail demand there. So flexibility, paying to the grid. You could have solar, electric cars, energy storage, EVC, heat pumps, all that stuff. And this is sort of better margin essentially. And if you look at this, you can see energy services and energy supply. They were into this market growth. There's not a lot there. The EBITDA margins there really wafer thin, 1 to 3, capital high. Now they're into this. EBITDA growth in the market 10 to 20%, EBITDA 10 to 20%, and working capital intensity low. So it makes a lot more sense heading towards that business model transition. And like I said, it takes a while for people to get their head around when a company changes direction a little bit. I mean, their ethos is still the same. They've gone from generating, holding that generation and to being, supplying it in different ways. So basically, that's the size of the market, 5 to 10 billion addressable market in the UK. All right. So where do they source their electricity from? So solar from city centres, hydro from historic country estates in Wales, wind from Welsh hillsides. Our community of over 1,700 generators is full of inspiring people who are helping make Britain greener. We commit to matching all electricity you use at home with power source from renewable generators. Get to know who they are. And on the website, there's stories about these people that have all these wind farms and all that. But wind generators, solar generators, hydro generators, and that's where they source their electricity from. So I think that's got up to 1,800 generators they source the electricity from, but it's 100% renewable fuel mix, 46% from wind, 41% from biogeneration, 9% from solar, 4.18 from hydro. Okay, so these are the four parts of the business pretty much: solar and generation, heat pumps, renewable energy supplying people, so you can obviously get that off them and the thing, and supply and transport. Okay, so it's generation as well. So it's feeding back into the grid if you want, and transport. So let's look at transport first. This is Zapmap. If you've got an EV, you may be aware of this. I think it's the market leader in the place. It's an app that shows you exactly the kind of charges, where they are, where they're free. You can pay through the app as well. There's a lot of data goes through that. But yeah, if you look at it, I think FleetCor, UK's #1 fuel card service provider, has invested. So they just did a fundraise there, a Series A, £9 million fundraise. So post-money valuation, it's valued at 26 million. Now, Good Energy own 49% of that business. So that's the 13 million. So accelerate and payment consumer app, international potential going forward. And if you look at this, there are 534,000 battery EVs on the road, with 455,000 registered Zapmap users. And you can see here the users going up now, and it's almost like, I think it's just over 500,000, the last update, 500,000 registered users. 50% of users remain active on a monthly basis. Annual subscriptions, so they get, if people subscribe to this, there's a free service, but you can subscribe as well, increasing towards long-term target of 10%. 10 networks now signed up, covering 25% of the rapid network. All-star electric fuel card launch with FleetCor, positive uptake, and so it's growing very quickly. As I said, 26.3 million. They own 49.9% of that business. All right, and I say here, it's very interesting actually. Zapmap's the demand for unique data and insights is growing in lockstep with the market, and a new dedicated insights business is successfully fulfilling this as a strong commercial proposition. You can see exactly where people are, recharging, for how long, and all that stuff. So there's a lot of data there going into the app, which could be very valuable. And research by Zapmap indicates that EV drivers are 7 times more likely to have solar PV installed than the national average, with 29% of respondents having solar panels on their home. So you can see that these people are a rich vein of potential customers for them, because the people that have EV are more likely to get solar on their roof to charge their car. And so there's that sort of area where they can tap into. All right. Let's go to heat pump installations underway, targeting our supply customer base and Southwest focus. So they acquired Igloo Energy for initial consideration of 1.75 million in December the 2nd, 2022. Following the acquisition, Igloo Works heat pumps have continued to grow, and we are targeting 500 installations in 2023, and to build the capacity to 12,000 per year. Huge ramp up there, but they've got the money to invest in the business and scale it up. That's the good thing. They've got a lot of cash to acquire businesses, that complement them, and then ramp them up, invest in them, and ramp them up. So that's a huge ramp up there, from 500 to 12,000 per year by 2026. Like I said, we are focused on existing 6,000 domestic supply customer base. Future ambition is target 1.5 million boiler replacement market there. And you can see here, this is how heat pumps are going. They're at a £2 compound annual growth now by 2030. I think isn't that the date, I think, when you can't install new gas boilers, and so it's going to grow massively between now and 2030, and they're going to be part of that install base there. Solar and generation. First solar installs and provided domestic and business solar export. So they acquired Wessex Eco Energy about a month back. Track record of high quality installs with 5-star Google review rating. Initial consideration of 2.5 million, payable in cash, and deferred consideration of 1.5 there. Okay, now day one initial consideration price less than 6 times EBITDA multiple based on forecast 2023 earnings. So revenue for the year 31st of October 2023 remains on track to exceed 4 million. That's for the business they acquired, of course, Wessex. For the financial year ended 31st of October, they reported sales of 2.2 and a net profit of 300,000. So you can see the growth here from one year to the next, from 2.2 to 4 million. So it's growing very quickly. And of course, again, they'll invest in this and scale it. So they completed 155 installs in 2022. And following the acquisition, they will be targeting 600 panel installations per month within 18 months. Again, they're going to be ramping this up very aggressively, and they have the funds to do that and invest in that. So they say here, the acquisition is expected to be marginally EPS accretive in the first full year of ownership and materially accretive in the year ending the 31st of December 2025. So it'll ramp up, but it'll really make a difference by 2025. And again, there's a solar market dip down here after tariffs dropped off, but it's growing very quickly, as you can see here from, they're looking 2030 install rate up to 125% to 175,000 there by 2030. This is the broker views. Given the business has 277,000 customers, proven profitability over 2 decades, is the second largest feed-in tariff operator in the UK, and is one of the highest profitability customers in the industry, it is difficult to justify the stock trading with a market cap below 35 million. And in fact, on a trading update recently, they did say the business has performed more strongly than planned in the first months of the year. Profit in the first half will be high in this period, driving a falling and less volatile wholesale commodity costs. As expected, the second half will be loss-making, given the interplay between hedged prices of power and the gas current falling market prices. They've hedged a bit high, of course, with gas coming down, because they had to do that. So you never know it's going to go back up. But cash and restricted deposits at the end of May increased to 38 million, with strong profit performance of timing customer support receipts and the government support schemes. So 38 million is more than their market cap, but some that's restricted and some that'll unwind as well. Fully hedged third quarter, so that the majority of the working capital upside, that's from where they are now, about 19. I think they've net cash about 19 million, but that anything above that will unwind, so it'll come back to around about 18, 19 million, which is still amazing considering they're worth about 28 million market cap. So the group has performed well in the year to date, and the board is optimistic of a full year outturn in this point. So the board's expectations for the full year remain unchanged. So we'll look at that in a bit. Okay, let's look at the spreadsheet. Don't forget, this is the full year results on this side, left side. On the right, it's interim results. So this is the most recent to 31st of March. 174 share price, 29 million market cap. Now look at the enterprise value, 10 million. That's all. Net asset value, 38 million. Okay, that's because they have cash of 24 million. They've got a little bit of debt, so you take that off. Net cash of 19 million. So 19 pretty much, taking off that means 10 million. So it's crazy they've got cash of 24 million and they're 29 million market cap, or 19 million pretty much. But revenue 248 million. Okay, now the margins aren't that good, but they are going to improve. Operating profit of 1.1 million. Operating cash flow 5.4, and free cash flow 19. Of course, that's a sale of their assets there. Dividend cover, of 18, but 1.5% yield and plenty of cover, 18 times. Growth-wise, 70%, it's all good. Operating profit went down, 51, but it's still profitable. Like I said, triple digit here on all these, largely down to the sale of the asset. The valuations are silly, as in silly good. Price of sales, 0.12. Price of earnings, 4. Price to book, 0.75. EV/EBITDA, 3. Price to free cash flow, 1. So it's top scores on the valuation. So you've got growth, and those are the most important on a fundamental level, growth and valuation. So it's very good. Health-wise, net increase in cash, 17 million. Net cash of 19.2. They have got debt, like I said, and it would take 4.44 years to cover that on operating profit, but they've got 19 million in net cash, so they can pay that off when they want. So only 5 million of debt there, and they'll be chipping away at that anyway. Current ratio is good. Quick ratio, not quite there, but generally health is quite good. Efficiency, this is the issue, and it's one of the main reasons why they've gone to supplying services rather than being a supplier of power with their own assets, because that was a low margin business. Now they're transitioning to a higher margin business, and by that I mean they're really improving the margins 2, 3, 4, 5-fold. So that will translate in the coming years. But as yet, that's a weak part of the business, the efficiency, the margins of the business, and also right now momentum. The chart is not looking very good, but forecasts are very good because the value is so low. So let's look at the forecast. Like going forward, it's going to grow, predicted by 31% this year to 325 million. Yes, it is a 29 million market cap company. That'll dip a little bit because, of course, energy bills won't be so high, support won't be so high, and that'll dip. And then it'll grow again back to 325 in 25. But the margins are improving. I say you've gone from, PE margin there, 0.6 to 2.8, and that will get better as time goes on. But the returns you're looking at here, literally, on these growth figures top line, on the margins of 3, okay, before pre-tax profit of that, and post-tax of that, these basically margins, 2 and 2 and 3, which are big, and these multiples, 0.3 of sales, 5 times EBITDA, 10 times PE, these are the looking returns you're going to get. So 37% up for this year, 238. 114% growth for 2024, 372, and 499 pence, or 5 quid, say, for 2025, so 187. So let's just look at the broker targets. Pretty much, this is their 12-month target, by the way, and they have 2 analysts, one going with 476, one going with 434. The average is 456, which is 161% up for the year. So they're more bullish than me, but nevertheless, excellent upside on that. And just into a summary, looking at the scores here, you can see growth is very good, value is very good, health is fine, efficiency needs work, momentum, which it is being worked on, momentum, that needs to come on the line, and forecast. So we just look at the chart there. I said we had a takeover target and a hostile takeover bid with 4 quid a share being offered back here. They rejected that, but now it's come down, a bit of volatility. But I expect this kind of pattern to happen. This is pretty much a low, and I can't see it revisiting that. Like I said, because they now are valued below net asset value massively, and their enterprise value is 10 million. So how low can this go? And they are profitable, so they're adding to that asset base all the time, and they're buying businesses with acquiring businesses with better margins. And they have that that cash level to acquire businesses and improve them and scale them. So I can't see this going a lot lower here. This is the kind of forecast I see happening if it's going to line up with the fundamentals. Okay, hope that helped. Please do your own research.